Dividend Kings are also known as Dividend Royalty. These are among the most stable companies around. These companies provide stable results but also return money back to shareholders. After all, total return is what it's all about, right? You could have a growth stock that's up 50% today and down 80% tomorrow. But with dividend stocks, you are earning a quarterly or even a monthly dividend, a total return, earning profits in a company that you own. That is why I love dividend stocks. And in today's video, we're going to take a look at 3 of my favorite Dividend Kings to buy in 2023. As a quick reminder, a Dividend King is a company that has been able to increase their dividend for 50 plus consecutive years. Essentially, a dividend aristocrat times 2. And if you haven't checked out one of my latest videos, I went through every single Dividend King we have right now. So I will leave that link down in the description below. So with that being said, let's jump into the video. Hey everyone, Mark here, back for another video. And on this channel, we look to not only educate, but also keep investors in the know on what's happening in both the stock market and with dividend stocks. And today we're going to look at 3 Dividend Kings that are high on my watch list for 2023. But before we begin, here's a word from today's sponsor. Today's video is brought to you by Moomoo. Moomoo is a commission-free trading platform owned by the Nasdaq-listed fintech company Futu. It is available globally for users in the United States, Singapore, and Australia. Moomoo continues to have a great holiday sweepstakes where you can enter to win the top prize of $50,000 cash. Plus, if you use my link down in the description below, sign up for a new Moomoo account, deposit money, you could receive up to 20 free stocks to get started with. Moomoo has a ton of great tools. They have stock screener tools, paper trading for those of you that are just getting us started with investing. They also have institutional trackers where you can track the likes of Warren Buffett or Ray Dalio. But one tool that I use almost on a daily basis is their heat map. The heat map will color coordinate, so if you want to follow the S&P 500, you can see all of those companies on the heat map, and the boxes are based on the size or the weighting within that index. So if I want to see how the S&P 500 did, I can see a heat map of those companies right there on the screen. But this is just one of the many tools that Moomoo has, so definitely check out this great platform today. With that being said, let's get started with our first Dividend King for 2023, and that is Coca-Cola Company, stock ticker KO. The Coca-Cola Company currently has a market cap of $271 billion. The Coca-Cola Company is the largest beverage company within the industry, outpacing its closest competitor in PepsiCo. On the year, shares of KO are up 6%, which is a welcome sign considering the greater S&P 500 is down 20% on the year. Coca-Cola is a Dividend King as they have hiked their dividend for 60 consecutive years and counting. The company has a dividend yield of 2.8% currently, with a 5-year dividend growth rate of 3.5%. The Coca-Cola Company is a unique choice right here, and as I go through all of these stock picks, I am considering the slowdown that is expected at least in the first half of 2023, which will undoubtedly put pressure on Coca-Cola. But there are a few tailwinds for the company as well. A lot of the material costs, like aluminum, have come down over the years, and since their spike in March, the cost of aluminum has fell 38% thus far. So lower aluminum costs. Another area that I'm looking at is the reopening, the slow reopening of the China market, which is huge for a global iconic company like Coca-Cola. The company owns slightly below 50% of the US market share, and actually 3.1% of all beverages consumed across the globe on a daily basis are Coca-Cola products. This recession that we are potentially having, assuming we're not already in one, is one of the most telegraphed recessions to date. And that is why the CEO of Coca-Cola is already preparing. He is redesigning and reshaping the portfolio of products that Coca-Cola has, focusing more on popular, high margin, and products of scale. Coca-Cola does a great job of selling their products at great margins, and they also do an even better job of returning money to shareholders. Currently, shares of Coca-Cola trade at a current price to earnings multiple of 24 times. They have a 5-year average of 25 times. So as we look at it right now, shares are pretty fairly valued, but the company, again, does a great job of returning money to shareholders. The second dividend king for 2023 is Stanley Black & Decker, stock ticker SWK. Stanley Black & Decker currently has a market cap of $11 billion. They are the maker of professional grade power tools and accessories, owning the brands such as Black & Decker, Stanley, DeWalt, Craftsman, Porter Cable, and many more. The company has been around for a number of years, having been founded in 1843. On the year, shares have been absolutely crushed. Number one, valuation got extremely stretched during the early part of the pandemic, and now piling onto that is a slowdown in the real estate sector. And that has equated to shares of SWK falling 60% on the year, one of the worst performers in the S&P 500 in 2022. The real estate market will continue to be under pressure at least through the first half of 2023. But given this strong pullback that we've already seen in Stanley Black & Decker, I think a lot of that is already priced into the stock. The company, though, is working through a bunch of other areas as well, as they have a high inventory number that they're trying to get off their balance sheet right now, which will impact margins in the next few quarters. They also have an SG&A problem, so we're seeing layoffs within the company, which is going to bring down that SG&A number and bring up gross margins in the long term. Now remember, I am a long-term investor. I'm not always looking to buy stocks when everything is rosy. I am looking to take advantage of high-quality blue chip stocks just like Stanley Black & Decker. Given the valuation, now seems like a great entry point to add some shares of SWK, or you could choose to wait a little and add some in Q1 23 as we see how management is playing out, decreasing inventory and lowering SG&A. So why get into shares of Stanley Black & Decker, you might ask right now? Number one is valuation. From an enterprise value to sales metric right now, shares of Stanley Black & Decker are trading comparable to 2008. From an earnings standpoint, shares currently trade at 16.5 times next year's earnings and just 10 times 2024 earnings estimates, compared to a 5-year average of 19.2 times. So if you believe the US economy will go into maybe just a mild recession and get back moving again in late 23 or early 24, this is a very cheap valuation that you are seeing with shares of SWK. So number one is the cheap valuation. Another reason is the great dividend. The company does a fantastic job returning money to shareholders. Currently, the dividend yield on shares of SWK is 4.1%. And the company has increased their dividend for 55 consecutive years and counting. The 5-year dividend growth rate for the company is 5%. The third dividend king to consider for 2023 is one of my favorites, and that is Lowe's Companies, stock ticker LOW. Lowe's Companies currently has a market cap of $125 billion. They were actually one of my top dividend picks for 2023 in a video that I just released this week. So if you haven't seen that, I will also put a link down to it in the description below. But it would seem kind of weird if I had a dividend king in that one and then didn't put Lowe's in the actual dividend king video. As many of you know, Lowe's is the second largest home improvement retailer behind the likes of Home Depot. I like Lowe's for many of the same reasons that we just mentioned with Stanley Black & Decker. Although the company hasn't been punished as hard as Stanley Black & Decker, shares are still down 20% on the year. Although they are in the same industry in many aspects, Stanley Black & Decker sells a lot of their products at Home Depot and at Lowe's. Shares of Lowe's have not been as volatile as Stanley Black & Decker. However, when it comes to Lowe's and returning money to shareholders, not only are you getting a reliable dividend, a dividend that increases on an annual basis, but it has been increasing at a strong basis with a strong 5-year dividend growth rate for the company. So again, not only have they increased their dividend for 61 consecutive years, they're also growing that dividend at a 5-year dividend growth rate of 21%. Lowe's still has plenty of separation between themselves and Home Depot, but that's one of the reasons I like the stock so much. There's plenty of upside that you can see with the company, and that potential is beginning to play out. Just this past year, Lowe's has been out executing Home Depot on a number of different areas. And one of those reasons is because of the leadership of Marvin Ellison, who is a prior executive over at Home Depot. Lowe's shares have fallen 20% on the year, creating this great entry point. Lowe's shares currently trade at just 14.3 times next year's earnings compared to a 5-year average of 19.7 times. So there we have it, folks. 3 dividend kings for you to consider for 2023. You have the Coca-Cola Company, you have Stanley Black & Decker, whose shares have fallen 60% on the year, and then you have a great dividend king in Lowe's companies. And also, if you enjoyed the video, make sure you hit that like button, subscribe to the channel so you are notified anytime we drop a new video. And with that being said, we'll see you in the next video. Take care.